When you see someone flash a premium, heavy metal credit card, it's easy to assume the bank is making a fortune off their extravagant lifestyle. But the math tells a different story. The luxury perks, the free flights, and the airport lounges are heavily subsidized by the middle class. Look at this revenue breakdown for a major credit card issuer. Out of a massive 18,637 crore total revenue, nearly half of that pie isolates right here. That is pure interest income. Half their money comes from people paying penalties to borrow. When you swipe a card, you aren't spending your own money. You are spending the bank's money. They give you a 45-day grace period to pay it back. Settle the balance before that window closes, and the loan costs you nothing. But the exact moment you miss that deadline, a highly engineered debt mechanism activates. Convenient payment options like the minimum due button or the no-cost EMI drive this system. These tools quietly transfer wealth from everyday consumers straight into the pockets of the top 1%. The first method of extraction relies on gamification. Every time you swipe, you earn points. This works on basic behavioral psychology, acting as positive reinforcement. The system rewards you for spending, releasing a small hit of dopamine that makes it incredibly easy to justify buying things you don't actually need. A look at the math for a premium rewards program reveals the scale of what is required to earn a free hotel stay. To get 18,000 rupees in hotel value, you must spend a staggering 1.5 million rupees first. That yields a return rate of exactly 7.2%. If your normal monthly budget is 50,000 rupees, spending just 3,600 rupees extra to chase those points completely cancels out that 7.2% benefit. The reward system leads you into taking a net loss. This lack of spending discipline affects everyone, regardless of income. Even global pop stars have faced near bankruptcy after losing track of her cash flow, later realizing that simply having millions doesn't prevent you from spending millions. Points and cashback offers are engineered behavioral lures. They're deployed specifically to extract money you never intended to spend. The second psychological trap is the no-cost EMI. It is wildly effective. In fact, roughly 70% of all iPhones sold in India are purchased using this exact financing method. According to the central bank's regulations, institutions are not actually allowed to offer interest-free loans. The no-cost label is a mathematical illusion. This flowchart tracks exactly how the transaction works on an 82,800 rupee phone purchase. The seller applies a 6,000 rupee discount, but the bank adds a 6,000 rupee interest fee, returning to the original price. By spreading payments, your bank balance remains artificially high. Feeling wealthy, you justify adding high-margin accessories to the same cart. The no-cost EMI doubles the total value of your cart by masking the anchor item's true immediate price. At the end of the month, your statement arrives showing a massive balance, say 68,000 rupees. But right next to it, bathed in a friendly highlight, is the minimum amount due, a tiny fraction of the total cost. Paying that minimum amount immediately revokes your 45-day interest-free period entirely. This timeline shows the true cost. Paying the minimum triggers a 40 to 50% interest rate, applied retroactively to the exact purchase date. Unpaid interest generates its own interest, bending the chart upward exponentially. You become a revolver, continuously pushing a snowballing debt. Selecting the minimum due represents the precise moment a user transitions from a customer to a permanent source of compounding revenue for the bank. But there is a second group. Roughly 30% of users are known as transactors. They pay their entire balance in full, exactly on time, every single month. They actually cost the banks money. Banks willingly take a loss on these individuals. They hand out premium lounge access and free flights to lure these clients' massive wealth management and investment portfolios into the bank's ecosystem. You can force yourself into this transactor behavior by effectively turning the credit card into a prepaid debit card. Calculate your absolute monthly necessities. Then, transfer that exact cash amount to the credit card company up front. You establish a hard cap on your spending before you ever make a single purchase. This stability is measured by your credit utilization ratio. If you spend 100% of your limit, you appear desperate for credit, which lowers your score. Keeping that spend under 30% of your total available limit signals that you are in control, cementing your status as a high-value transactor. True financial control comes from actively restricting your spending capacity up front to physically eliminate the bank's engineered temptations. Credit cards are neutral tools. In a capitalist economy, businesses are supposed to incentivize you to spend money. That is their duty, but you are responsible for protecting your own wealth. The entire economic ecosystem relies on this dynamic. All the way up to top government leaders, there is a constant, unified push to encourage mass consumer spending during sales and festival seasons. The final rule is absolute. Only swipe for planned, budgeted expenses that you are going to make anyway. Collect the cash back, reap the rewards, and never pay a single dime in interest. The system is designed to extract value from you. Mastering these strict boundaries transforms you from the target of the financial machine into the one exploiting it.